when you analyze the performance of whether it's billionaire hedge fund managers or the 20% of retail traders that win, this is what out of 100 trades their performance looks like. Now, people actually assume that hedge fund managers or profitable traders have some crystal ball that allows them to see into the future. If that were the case, they'd have 100% big winning trades. They don't, because they don't have a crystal ball. And if they did have 100% big winning trades, they would have cornered the market on money. Self-evidently, they haven't. So we know that's another reason why. But we also know this data is correct off the back of the analysis of any long-standing profitable hedge fund, whether it's a Brevin Howard or whether it's Winton or AHL. This is what it looks like. So how and why does the structure look like this? Well, first of all, they make sure they don't have big losses because they don't add to big losers. The few times that they break those rules, they usually end up going bust. Look up long-term capital management. That ridiculous hedge fund which went against clients. When they get the big losses, it'll wipe them out. That's why we are so fearful of big losses and we don't add to our losing positions. So what about these small losses and small wins? Why did they have them? Well, like I said, we don't have a crystal ball. We expected every trade we entered into to be a high probability trade of a move up, but then somebody does a tweet, the market moves against us, so we end up with some small losses which are pretty much erased by our small wins, which we also had to exit because they ran out of momentum or direction. There wasn't any profit to be made. The 20% or 25% of trades, and you can write this bit down, 80% of your profits will come from 20% of your trades on the whole. Those big winners come from when the trend just went in our direction and continued and continues, and we added to our winners. We either skyscrapered in other words, we added another position of equal size as our original position once we were in profit, so we risked our profits to make more profits rather than risk our initial capital at the outset too much. Equally, we might have pyramided in. We added half a position compared to our original position. Whatever it was, winners add to winners. Sadly, we don't have the crystal ball to make sure we only get winning trades. My job as a hedge fund manager is not to out-analyze Goldman Sachs or see into the future. My job is to ride the coattails of the trends they've already put into place. I'm not trying to gamble on which way I think the future is going to go. I'm trying to ride the trends which are already in place. In other words, I'm not trying to be Albert Einstein or Isaac Newton. I'm trying to stand on the shoulders or ride the coattails of those who move the markets instead. That's a critical understanding most people don't have of what the hedge fund industry largely does.